Welcome back. Well, the market's having a bit of a dichotomy today, which is the large cap indices are moving down and the mid cap index is moving in the green. So mid cap index is up 0.5%, advanced decline at about 2:1, but it's the bank Nifty, which is the problem point. 2% down now on the bank Nifty, and that's the point. The Nifty has still got a couple of legs moving for it, but on the bank Nifty there's a lot of selling pressure, which is visible. The Nifty is being supported by names like Infosys, Eicher Motors, couple of pharma names, but the bank Nifty is under some selling pressure, led by ICICI Bank, but others like Kotak Mahindra Bank, HDFC Bank, SBI as well. IndusInd Bank, in fact, is the top loser. So let's do one thing. Let's get some fresh technical calls then with Mitessh and Prakash. Good morning, Mitessh. Not been a good first hour, but I was looking at the market. Interestingly, the call prices are not falling lots and the mid caps are doing well. Your thoughts on the overall setup and your stock calls?
So I think it is a market which is still in consolidation. I said that while we did well to recover from the lower levels, I think the market hasn't yet given a signal of restarting the uptrend. So I think it's a buy on declines market where you would see some consolidation happening. And then I think once the base is built, I think then you would see the indicators turning up again. So I would remain positive in that sense, but not be worried unless until we start breaking 9,700 on a slightly medium-term kind of perspective. So stay positive. Use intraday declines to buy into stocks which are showing extremely good patterns. And I think pharma as of now is in a very sweet spot. I have buys on Cipla as well as Dr. Reddy's. So Cipla is a buy with a stop at 638, targets of 675 here, and DRL is a buy with a stop below 4040 for targets of 4300.
Oh yes, pharma clearly is a sector which is doing well, led by Lupin, which is up about 3% right now. And by the way, the other stock doing well after last 2-3 days of thrashing is Z Entertainment. That's making a bit of a comeback. On the market, it's the first sign of some recovery on the Nifty. Let's see. But the mid-cap index is really soaring away right now, 100 points higher now on that index. There can't be more bipolar nature of the market than on display today. But Prakash, what would be your calls now at 10 a.m.?
Good morning to you, Anuj. Well, so far when I look at the Nifty, it tells me it is weak, but it's not really weak. So possibly we'll see support in the lower regions. So far, it looks like it's into a trap zone. For buying, you need to see strength or maybe a weakness in the weakness. I think maybe in the later part of the trading session, we could see that. Whenever it happens, there's a buying opportunity there. I'm not selling for sure. So I have two stocks, one long, one short. One is Torrent Pharma, looks good, very good chance. We can see it climb to around 2,600 zones. Stop below 2,500 should be fine. Pharma is looking okay. Coal India is weak. Possibly we'll see it slide to around 127 zones, stop about 135.
All right, Mitessh and Prakash, thanks a lot for those calls. Now, Lata, what's interesting is the, if you see the hourly low now, that will become the sacrosanct number. As I said, the mid-cap market is still doing fine, and the call prices are not falling on the Nifty, despite the market actually seeing a bit of a decline. So, the bet on the market seems to be that at some point this dip will be bought. That's the prevailing view right now. We'll see if that view is right or not.
Okay. No, I'm not surprised. I mean, people would logically have that view simply because there is so much of cash floating around. Though at the moment, Dow Futures is still 1.5 down and Asian markets are also not helping. The liquidity is something that you have to respect. As Vallabh Bhansali said, it can flood in any moment, and you don't want to be caught sitting short at a moment when it floods in. I can imagine the dichotomy that traders would be having in their own mind, and I guess at that time looking at the call rates would clearly help. That's a great help. Well, at the moment we are looking for Suresh Ganapathy. Oh yes, he's there. Suresh Ganapathy of Macquarie Capital Securities joins us on the line with his take on all things financial. Well, Suresh, first of all, we are so happy to have you back with us. A word on the brave fight that you put up and the safe landing.
Yeah, I mean, it's not easy at times, but what is very essential, in my opinion, to fight COVID is basically you need to be very, very mentally strong. I think it's not easy to go through a period of 14-day quarantine and also hospitalization where it's very, very challenging. But I think people have to understand it is curable and we should not necessarily panic. The disease definitely doesn't have any permanent solution as such. You're not treating the virus, you're treating the symptoms. But then, as I said, mental strength is something which should not be underappreciated in a fight against COVID battle. And that's what I would request everyone to be very, very mentally strong.
Absolutely. I take your point. We are not concentrating enough on mental health. We concentrate way too much on physical health. And it's important to note that in terms of number of cases per million in India, we rank way lower than the world. Even if you blame that on lower testing, the number of deaths per million, now that can't be hidden. Even that is, we are 110th in the list of countries. So, maybe it's a country which has seen much more dreaded diseases, maybe malnutrition and lack of hygiene has made us sturdy in some sense, or maybe the variant that's attacking us is weaker. But for whatever reason, it's not as fatal. You don't want to fall sick, but the end is not fatal. People have to get that and strengthen their minds. I'm sorry I'm waxing eloquent on this, but I just feel that people are getting way too scared. As Rajiv Bajaj said, the fear is more important to treat than the flu itself. The fear is taking a toll. Okay, now to come back to the real financial problem. What is your estimate of how the banking sector will look like by the end of the year? How much, which are the banks that might require more capital? And what is your vague estimate of how bad the asset quality could look?
Yeah. So, Lata, the way we should look at it is that, what percentage of the book could be under moratorium and make a rough guess estimate as to how much of it that can go back. Now, the conversations reveal that, of course, right now already 30% of the banking book is already under moratorium. Maybe this number touches 40% by the end of August. So, you take a rough anywhere between 10 to 20% from a sensitivity standpoint as to how much of this book could go bad. Now, if I say 10% or 40% goes bad, which means you're talking about a 4% slippage ratio, or if you're talking about 20% or 40% going bad, you're talking about an 8% slippage ratio. So clearly the worst case outcome could be, in my view, as of now, 20% of the book going bad, which means the public sector banks would easily require anywhere between $20 to $30 billion of capital infusion in case the worst case outcome pans out.
Okay, got that. Suresh, hi, good morning. And from my side as well, congratulations on a speedy recovery. It was really a tough time for you as well as all your family and friends. So good to see you back on TV. I wanted to ask you, particularly on retail NPAs, a lot of these banks, as ICICI Bank, for example, has 50% of the retail book. IndusInd Bank has an exposure of 36%, Kotak Bank 40%. Do you fear that there could be a ballooning of bad loans purely in the retail side, which could make it worse for some of these banks that have a high exposure there?
See, the secure segment should be broadly okay. I think, in my view, clearly over the cycle, the loss given defaults in the secure segment like home loans, some extent auto loans are going to be manageable. The real problem could be in the unsecured segment where, in my opinion, there is a possibility that some element of loss rates can go up. Having said that, Sonia, I think a lot really depends upon what could be the extent of recovery here, because if you're really talking about some kind of an L-shaped recovery, then clearly I'm going to be very, very worried about the retail asset quality. But in case the second half necessarily recovers, I think some of the problems on retail asset quality are exaggerated. One has to understand that any NPLs at all, if it comes in any segment, whether it is retail or corporate, will come, Sonia, only in the Jan to March quarter, because you're already there in moratorium till August, and then you have another 3 months for recognition of NPLs. So by that time, in case the economy recovers even partially, some of the problems could be relatively manageable. But yes, retail unsecured loans is one area where there is greater amount of risk in our view.
Is it as bad or even worse in SMEs? I mean, do you think the propensity to turn into NPAs is higher for banks that have an exposure to the SME space? And which are the ones that you would be most concerned about now?
Yeah, sure. So clearly, I do believe that the SME space is far more vulnerable than the retail space, because the way we look at it is that the retail balance sheets or an individual's balance sheet is relatively much safer compared to an SME balance sheet, because Indians are not that very highly leveraged. They have, of course, some savings here and there. And I think I do believe that many of them will be employable in the job market. So once they'll end up getting a job, obviously it is much more manageable. The real challenge is SMEs, because some of them could have quite a permanent damage on their overall business. The gearing is also relatively higher. And the ones which have a very large exposure to the SME space is public sector banks. And that's where I think, eventually, if you look at it, the capital requirements are also for them are higher, because almost 20% of the book, 15 to 20% of the book is SMEs, which are far more vulnerable, and NPLs can really go up, and loss rates could also be higher in the SME space.
Okay, that's great perspective.